In this video, we're going to talk about 3 stocks that I intend on holding forever and why I plan to do so. So stick around and find out. Hey everybody, Ryan Foster here. Drop a like if you find this video helpful. And in this channel, we talk about personal finance, investing, real estate, and much more. So hit that subscribe button and join me on your way to financial freedom. And without further ado, let's get into today's video. Now, when it comes to stocks that I plan on holding for a very long period of time, ideally forever, I really want to look at some major things like sustainability, how established that company is, and how long they're able to stay in business. And I also kind of look to see if it's what I would consider to be recession proof. Now, what that means is in good markets, a lot of companies will do well, but when we're having a bad market, I want to be able to make sure that the company will still be able to sustain itself and sustain business even during a weaker economy. So that's something that's kind of crucial to me, because if I'm going to invest for the long haul on something like this, I really want to make sure that it's not going to be, obviously there's going to be risk, but it's not going to be that risky where I would be scared that if we were in a down market that this company wouldn't stay afloat. Now, these 3 companies I think will always be in business. Hopefully, you never know, but ideally I think that they have built themselves up to a point where they're almost untouchable. I say almost because anything can happen, right? The second thing really kind of ties into the first in some sense, because the sustainability in a bad market is important. But what a company does to do that is usually they don't have a lot of debt, because a company that has a lot of debt in a bad market, they still have to pay those debts every single month or quarter, or however they have it done. Their expenses, if they have high expenses and debt, they're still going to continue to pay those even when business isn't as well. And those companies tend to get weeded out in a bear market because they have higher expenses and not as much cash coming in. So you want to see something that has lower debt and expenses compared to something that has high debt. And so you want something that's paying down their debts and investing well with good management, ideally, because if you have a good manager, they're going to be able to distribute that money and take care of it and protect it and ultimately grow that money as well. So you want to make sure that that's kind of important. That's kind of the nitty-gritty of it, but let's get kind of into the details a little bit of these companies specifically, because that's what you tuned in for. So one of the companies I intend on holding forever is McDonald's. And the reason I say McDonald's is because they are a huge company. I'm sure you've heard of them. They're all over the country. They're very profitable, and the systems are so simple. They can have high school or first-time job people come in and be able to operate this business and still be profitable. It's arguably the best restaurant because it is one of the most profitable and it earns the most income, which to me is a good business if it's profitable. That's what you're in business for, is to make money. So here we have McDonald's Corporation. This is just on Yahoo Finance, and it just tells you the previous close and things like that. Earnings per share, which means how much earnings you're entitled to per share. EPS, pretty straightforward. So one share of McDonald's, you're entitled to $7.62 in earnings from that company. And another thing that I find really important, this is the chart over the max, so it's consistent. It is pretty extended here, but I mean, this was the big crash we had. I mean, it didn't really affect it too much. I mean, it still did, go down a little bit, but definitely went up overall. So this is the dividend.com. So this company does pay a dividend. This is the current dividend yield, which means the annual percentage on the money that you have invested. So if you were to put in X amount of dollars, this percentage here is the amount of return that you would expect. So a cool thing about McDonald's is the dividend growth right here. They've been able to increase their dividend growth for 43 years. So if this dividend, they're paying out $5 total, right, per share. and it's paid quarterly, so that means they pay it 4 times a year. With that, they tend to increase it over a period of 43 years. So they go to 44 years next year, this will be over $5. So they've been consistently increasing it over 43 years, which I think is a wonderful thing. So they've been so profitable every single year, they've been able to contribute more money back to its shareholders. The dividend yield is just based on the current share price. So if the stock's up a little bit, the yield is still paying out $5. It goes based off of that. I don't consider that as important as how long they've been able to pay out and grow that dividend for the, years to come. That's one of the reasons I did choose McDonald's, because it is a huge company. And if you think about it, just off of the stuff they have, I mean, everybody has a McDonald's. McDonald's is a really good company, I believe. And it's something that in a recession, people are still gonna buy it based off of convenience, because it's a convenience type food. So people will continue to buy even a recession, because at the end of the day, everybody has to eat. Okay, so the next stock is, you guessed it, Coca-Cola. So that's one of the companies I think that is a phenomenal company. Coca-Cola has been around for years, and I think that's a huge benefit to Coca-Cola. They're very profitable as well. Everybody knows the brand. Let's get into the data a little bit. So here's the data a little bit. This is the Coca-Cola, the symbol is KO on here. This is the chart, the max chart on here. I mean, it went from very low to pretty high. They have a dividend of 2.77%. This is their ex-dividend date, which means you must be a shareholder by that date in order to be entitled the next dividend payout. I don't really look at the hold or anything like that, because I don't think that's as important. They're pretty profitable as well. And here is the from dividend.com again. Now they got 2.78%. The market's moving constantly, so you'll have that. This is $1.06 per share paid out annually, and that's split up, paid out every quarter. And their dividend growth is 57 years. So they've been able to consistently either maintain or increase that dividend payout year after year after year, which I think that is amazing. Click on the payout history here so that way I can show you. Okay, so this is the payout. This is not over the whole, all of it, but as you can see here, it's been consistent since '96. They've consistently, you see that they've raised their dividend. They'll have 4 payouts here, then it goes up 4 more, and it goes up 4 more. So, because they pay out every single quarter, which is 4 times a year, and they consistently raise their dividend payout year after year for 57 years, which I think that is amazing. And if you think about it, if you're reinvesting those dividends, each time you're buying more and more shares, which they'll pay you more and more dividends because you own more shares. And then with those more dividends, you buy more shares, and it just keeps growing and growing and growing. And especially if they increase that dividend for 57 years, that tells me that the company is very strong as far as being able to contribute some of those earnings. They're not just keeping all of their earnings. They have so much money that they're paying dividends, and they're giving back all that money that they make back to the shareholders who own that stock. So if you're consistently buying them, you're growing your money and buying more, like I said, and it just snowball effect into wealth, which is good if you're in the market to make more money. So the third company is Procter & Gamble. And I might not even sound familiar to most people, but I almost can guarantee that you do own some of their products in your own home. The thing that's really attractive about this stock to me is how diversified they are. And what they really hold is a lot of consumer-based products, stuff you use every single day, and you don't even know it. That's one of the things I think is spectacular about this company. Let's get into the finances a little bit about it, so that way you can kind of see where I'm kind of coming from on that aspect, and then we'll dive into the reasons behind why I think they may be recession proof. So this is Procter & Gamble company. So the ticker is PG on here. They pay out a 2.38% dividend yield, which is, like I said before, annualized. This is their stock chart. A little bit choppy, not as pretty looking, but it is a great company, I believe. So let's kind of go into the dividends a little bit. They've been able to grow their dividend yield for 63 years consistently. So they've been able to, like I said before, grow the dividend year after year, which I think is crazy. Also paid out quarterly. So here are some of the brands. This is the logo here. So let's kind of cover some of the brands that they own. I'm sure that you've seen some of these before. So they own things like Pampers and Loves. Now, this is one of the reasons I think that this company is going to be, in a recession, still able to stay afloat, because at the end of the day, 60, 70, 80, 90, 100 years from now, I'm pretty sure babies aren't going to be potty trained as soon as they're born. I mean, I could be wrong, who knows, but I think that's a great thing that they have things like that. And then they have far more products as well. So you have like Tide Bounce, Downy, Ace. So I mean, if you're doing laundry, they have those. You know, Gain. There's so many things. They own Bounty, Charmin, Puffs, tissues, Always. I mean, feminine care, I'm pretty sure going to be around. You know, they have different hair care, Old Spice, Pantene, Aussie Head and Shoulders. You know, home care, they own Dawn, Febreze, Cascade, Gain, Mr. Clean Magic Eraser, the Swiffer, so many more. When it comes to grooming, they own Gillette. You know, it's Venus, Gillette. There's so many different things that this company has owned. Pepto-Bismol, Vicks, Z-Quil, Crest, Oral-B, Scope, Skincare, Olay, Ivory, Old Spice, Safeguard, Gillette, Secret. You know, there's so many things that this company owns. So when you're diversified like this and you own all these companies, well, Procter & Gamble is the company, but these are so many different areas that they kind of have the market for consumers that are going to buy this day in and day out. You know, even in a recession, like I said, babies are still probably going to need diapers. People are still going to do laundry, you know, and I think that these brands are strong. People still are going to buy Febreze and paper towel and things of that nature. These are things I think will always be around, and they've been able to consistently pay out a dividend, which if you reinvest that dividend, ultimately you're able to grow that portfolio a little bit larger. And I think these are some of the things that are recession proof. I mean, I could be wrong, but who knows here? I think that's pretty important. All right, everybody, that about wraps it up. Those are my three: McDonald's, Coca-Cola, and Procter & Gamble. Those are three that I think are pretty well established and really built up their reputation to be a good company. And I think that it's something that I will personally hold forever, ideally. And, you know, I recommend you always do your own research and look into it yourself and find out. Don't just take this from me, but really just look into it. And that about wraps it up for today's video, everyone. Hit the like if you did find this helpful. Subscribe so you never miss out. And until next time, I will see you in the next video.